Hi, this is Robert Cole with the Grow Group at Nexa Mortgage. I know you've been hearing a lot about temporary buy downs, seller buy down rates, permanently temporary 2.21, 321. So, what I decided to do is put a guide together to help you find the right buy down for you. So let me walk you through some of the definition what a buy down is and the pros and cons behind and which loan programs actually are able to use buy downs. So let's get the definition of what a buy down is. A buy down is a way for a borrower to obtain an interest rate lower by paying discount points. Discount points are also called mortgage points or prepaid interest points, and it's a one-time fee paid up front. In case of discount points, the interest rate will be lower for the term of the loan. Does it work for all loans? The loans, majority of the loans, yes, it does. VA loans, FHA loans, adjustables, jumbo, and conventional. Non-QM loans do not have this option, but the majority of loans in the United States that are being used do have the option of using a buy down loan. Two types of buy downs. One's a temporary buy down, and the other one's a permanent buy down. Temporary buy down is you would temporarily reduce your interest rate depending on which buy down program you exercised. And with a temporary one, it does require for the seller to give concessions for the buy down to be executed to lower that rate. A permanent buy down is where you permanently going to reduce the interest rate over the term of the loan. It will not adjust after it will only adjust once, of course, you pay the loan off, but it will never adjust based on the loan that you actually received. Now, the temporary rate buy downs. Once again, there's two of them. There's a 2-1 buy down and a 3-2-1 buy down. So on a 2-1 buy down, for example, let's say you have a 6% rate and you do a 2-1 buy down, meaning that your rate will begin the first year at 4%. Your second year will be 1%, and then on the third year, once the buy down expires, it'll go back to the original rate of 6%. On a 3-2-1 buy down, it's the same scenario, but the rate will go even lower. So we'll start at 3, then it'll go to 4, then it'll go to 5, and on the fourth year, it will actually go back to the initial rate that you qualified for, which was the 6%. Now, on a permanent rate buy down, the rate you permanently are buying the rate for the term of the loan. So if you bought it down to a 5, it will stay that way. If you did a 30-year loan, it will stay that way for the next 30 years. Or if you bought it down to 4, it really depends on how far you bought the rate down. But once you buy it, the rate does not go back up to the original rate that you bought it from. It permanently stays at that rate. Of course, there's pros and cons to everything. So let's talk about the pros and cons behind a temporary buy down. The pro, of course, you lower your the rate down temporarily. I mean, the whole point of doing a buy down is to temporarily give you some relief from a higher payment. The other pro is any unused funds that are left if you refinance the home before the 2 years are up will get applied towards the principal of the balance of the home. The other pro, the funds are required to come from the seller. So those funds that you're using to buy the rate down actually will come from the seller. And once again, the other pro is the whole aspect of the reason why you did the temporary buy down is to temporarily reduce your mortgage payment. Let's talk about the cons. Buyer can't qualify on the lower rate, meaning that if the original rate was 6 and you bought it down to 4, you still have to qualify at the 6% that you originally started from, because they want to make sure that if you never refinance the house and you actually the temporary buy down expires, that you still qualified and are able to make the payment at that 6% that you originally had. Once again, it's temporary. The relief from a temporary buy down is not as solid over time as a permanent buy down, but it's a temporary relief that you will get. Buyer would need to refinance if the market drops. So one of the things you got to consider that if you're in this market today and you want to refinance later, but the value of the property drops, you may not be able to qualify to refinance because there's not enough equity for the lender to take the risk to want to qualify to be able to take the risk for your property to qualify for the refinance. And of course, I'm a forward buyer does needs to still worry about a job. We're in that recessionary period. We're not in a recession, but the atmosphere feels that way. So one of the things you have to be concerned with is that if you're doing this for a temporary reason, you got to make sure your credit scores stay up and you're still employed by the time you're ready to make that refinance permanently to lower the rate at the hopefully the lower rates that are at that moment. Now, what is the pros and cons behind a permanent? The rate is fixed for life, so the rate doesn't change. So if the market never changes and it continues to linger a lot longer than expected, you don't have to be concerned with the rate adjusting. It's going to stay where it's at. You can qualify at a lower rate. So meaning that because you permanently bought the rate down, when you do qualify for the mortgage, it's going to be based on the lower rate that we brought the rate down to. So sometimes we do that when the debt to income ratio is too high, but there's enough funds to buy the rate down. We would buy the rate down to still get the borrower to qualify to purchase the home. At this point, with a permanent rate buy down, once again, affordability is addressed. The main reason why demand has been decreased, and at least in the market today, is because interest rates are what they are. And one of the ways to address it is by making it more affordable for someone to be able to qualify. One is to be able to be comfortable making the payment. The buyer does not need to refinance if they don't want to down the road. And nothing's going to change for them. If the market never changes, they can stay there without having to make any decisions. And of course, since you're not going to refinance, hopefully you don't lose your job. That's something that's not of concern to you. If you do lose your job, because you don't need to refinance, it will just stay where it's at. Now, what's a con? Buyer may want to refinance if the rates drop, and something to consider. It is not required to use seller funds for a buy down. In the temporary, you have to use seller funds, but in the permanent, you don't. So one of the cons is that you may have to come out of your own pocket to do it, to buy the rate down, but you may be in a position for the seller still willing to give it to you, but just be aware it's not required for the seller to do that. And two, no unused funds will be applied towards your principal if you decide to refinance before, because remember, there's no expiration period for the rate buy down. So no matter what you do, those funds that you use to buy the rate down, there's nothing that's going to be applied to your principal like it's going to be applied if you would have done a temporary buy down and you did a refinance before your rate expired to go back to the initial rate. So there's a ton of options for a buy down, and it depends on what your strategic goals are for the next 2 to 3 years. But in general, I tell a lot of people, figure out what works for you. Once again, the reason why I put these scenarios down here is for you to have an idea what may work for you based on the situation that you are going through. But in general, it helps create affordability for buyers. The market needs to continue. The U.S. market moves when the real estate market moves. And we need to create scenarios or situations where we can still do that. And one of the things you got to be conscious of as a buyer is that inventory is going to still be an issue once the market gets better for when it comes to rates. But in general, inventory will always be an issue. So if you guys have any questions, please do not hesitate to reach out to me. My calendar link is above, but you will see below all those scenarios, and one of those scenarios might work out for you. But if you have any questions, please reach out to me, call me, text me, or send me an email. Take care, and hopefully this guide will help you guys move forward with making that transaction happen. Okay? Bye-bye.